Good evening, everyone. Welcome to our University of Virginia Alumni Homebuyer Workshop. My name is Jason Maida. It's good to be with all of you this evening. Thanks so much for taking time out of your busy schedules on a Wednesday night to join us for our class. This is a class we teach 4 times a year, so once a quarter we offer this class. This is our second installment of 4 classes for the UVA alumni this year. So really excited that you took time out of your schedules to join us. This is a very interactive workshop. So as we get a chance to go through all of our wonderful content tonight, we'd encourage you to ask questions of us. You can use either the Q&A function within Zoom, or you can use the web chat, and we'll answer at either spot here in tonight's class. We're also recording tonight's class, so we'll send you out the link from the recorded version, which will also be up on our YouTube channel tomorrow morning, and all of our presentation material will get a chance to send back out to you via email, since you've obviously set up for this class. We have a lot of excitement for this class, and it's something we get a chance, like I said, to do 4 times a year. And the runtime for our class will take us up just about to the top of the hour. So as I go through tonight's content, we'll weave in questions and answers for our audience. And so again, we're really excited to be able to bring this to you. Just a little bit about our organization. So we've partnered with the Alumni Association to bring our educational platform and discounted mortgage services to the Alumni Association. American Pacific Mortgage is a nationwide lender, so we're one of the top 10 lenders in the country. In fact, we're ranked number 9 as lenders from a volume perspective in the country. Our team here is one of the top 100 teams in the country. And again, we connect with our local communities through our educational platform. So essentially, we teach classes like this online. And then as clients are interested in homeownership at some point in time, we'd love to be able to get connected with them and then help guide them on that journey towards homeownership. So all of our kind of success stories in the communities that we serve, more often than not, it starts with classes just like this. And I've been had the pleasure to help several of your fellow alumni become homeowners across the country, and it's something obviously that we take a lot of great pride in, being someone that can help support you on this journey. Well, let's talk a little bit about what you're going to learn in tonight's class. So we have a lot of great impactful talking points. We are going to spend some time looking at the housing market this evening, also talk a little bit about interest rates and what's going on. A lot of topics there that we can kind of explore. We will start our class with a budgeting exercise. We're going to look at what does it look like to rent versus comparing it to buying a home. We'll also spend some time looking at credit. How can I optimize my credit score to make sure I'm in the best possible position from a qualifying perspective and overall kind of cheaper financing? Speaking of those financing tools, we're going to talk a little bit about loan programs that are offered to you as home buyers and what might work best for you given your financial situation. We're talking a little bit about savings for home ownership. How do I get in a position where I have sufficient assets towards my home purchase? We'll also spend some time looking at first-time buyer programs that can supplement what you would need to purchase your home. And I also want to spend some time looking at the 6 steps of buying. So after tonight's class, you want to kind of figure out, like, where do I go from here? Now I've learned all this great stuff. Where do I take this and kind of apply it? We're going to walk you through the 6 steps of home buying. And I want to share with you a little bit more about what a consultation looks like for us. And so how do we connect with you via video to kind of share with you what a home buying scenario might look like for you? And that's a no obligation opportunity that we have for every one of our attendees for our classes. And we'll talk a little bit more about that later on in our class. Well, again, I'm glad you're attending tonight's class and join us for this session. We hopefully you find 1 or 2 things that you can take away on your journey towards homeownership. And when we think about homeownership, it's probably going to be one of the biggest financial decisions you decide to make. So I know there's a lot more exciting things you could be doing on a Wednesday night, but obviously our class understands, the significance of homeownership. And so taking time out of your busy schedules is obviously, it's a big deal for you, right? And so when we think about buying, we have to first of all ask ourselves, does it make sense to even consider homeownership? And I think as you kind of apply that question, I think you should kind of think more about what goes into homeownership. When we purchase a home, we have the opportunity to create a little better stability in our housing budget, so we don't have to worry about our rent increasing on an annual basis. If we decide to make the decision and purchase in today's market, well, it's a little bit of elevated interest rate levels. But at the same time, once I become a homeowner, I will have a future opportunity to refinance my home as potentially interest rates go lower. And this is an asset that I'm going to purchase normally this asset will appreciate over time. And as that asset grows, the difference between what the market value is of my home versus what I owe on my mortgage is called home equity. And for most of us across the country, that's like the number one asset we have in our portfolio. So that wealth is, a lot of wealth is created through real estate. And it does have the opportunity to really create generational wealth for some families. Now, there are also still some tax benefits that can be with home ownership, which should include potential tax deductibility of interest. And there can be other tax benefits when I decide to do energy efficient upgrades to my home. So when I look a little closer at home ownership, I always encourage clients, don't look at your rent budget towards your home budget as maybe an apples to apples comparison, because we really want to factor all of the benefits that come along with ownership. And to help kind of illustrate that point more, I thought we would take some time to look at this rent versus buying calculator, where we can kind of look and dive a little bit deeper into home ownership and figure out, like, when we stack up side by side renting versus owning, where are the benefits going to be for me? Now, again, in case you missed it, because I know we had a few of us joining class late, we are going to record tonight's class and share all this presentation material, which will include this calculation that I'm going to walk you through right now. And for time purposes in tonight's class, I kind of pre-filled everything in to keep us on track. But I want to walk you through how you would use a calculator like this and explain a little bit of the rationale, if you will, right? So the first point of this calculator shows us what does it look like on the rental side of things, right? So we have a scenario here where someone's renting for $22.50 a month. They have renter's insurance. They expect their rent to go up about 3% on an annual basis, right? So probably pretty reasonable. Now, I didn't ask our audience or poll our audience where we're joining our class from, but I think most of our conversations tonight will be centered around the DMV area. If you feel comfortable putting your location or your intention of where you want to purchase in the chat, if you want to drop that in, that might be helpful for us too, because as we talk a little bit about market data, you might be in the DMV area, you might not, but if you want to put your location, that would be great, because then we can better understand kind of where you're considering purchasing. But ultimately, with our rental scenario, we're putting $22.50 as kind of our baseline budget. And then from a home purchase perspective, we put in $450 as our sales price. We're going to learn a little bit about what minimum down payments look like in home buying, but ultimately it's 3% of the purchase price. And then we factor in the property taxes for buying my house. We have homeowners insurance costs, which, by the way, can vary based upon where I'm going to buy in the country. So if I'm in a area that maybe has more inclement weather, that I could have potential other perils that could impact my insurability of that house. Obviously, insurance might look a little different. We have maintenance costs in my house. And then we want to look at loan information. So generally, as a first-time home buyer, you're going to select a 30-year fixed mortgage. And then with that loan product, you're going to have an interest rate. Now, we're going to talk more about interest rates in just a few minutes, but I think it's important to understand, as first-time buyers, interest rates vary over time. They actually vary in between the trading day that you see in the financial market. So interest rates could look one way at 8 o'clock in the morning, could look completely different at 3 o'clock in the afternoon. So, but ultimately, we put a baseline rate of 6.6%. We have origination charges. Now, one of your benefits that you have as part of our Virginia alumni partnership is that we actually discount our services. So whether you're purchasing a home or if you're deciding to refinance, we reduce our cost by $750 just to create better overall affordability for our clients through our partnerships. And then we have discount points that essentially is where you as a buyer are deciding to pay additional expenses out of pocket in order to bring down your interest rate. Now, in today's market where we're still at elevated levels, it doesn't necessarily make sense to pay discount points. The break-even point for discount points can be anywhere between 3 to 4 years. And for most buyers deciding to purchase in today's market, they might even be considering refinancing in a couple years. So if I buy my house today at 6.6% rate, and then rates drop to 6 or 5.5% 2 years from now, well, I probably want to take advantage of refinancing. So investments like discount points generally don't make a lot of sense. A discount point is the equivalent of 1% of my loan amount, and usually that'll discount my rate by about 0.25%. All right, we'll talk more about that in just a bit. We have other settlement services, which essentially are closing costs to buy my house. We always encourage clients to budget about 2 to 3% of their purchase price for closing costs and what we call prepaid items in conjunction with buying a house. All right. Last other assumptions tab we're going to look at is what is my appreciation going to look like on my home? So we put in 4% for tonight's calculation that we're going to be in this house for 7 years as a projection. I eventually will sell the house in 7 years, and what's that cost going to look like for me? State and federal tax rates that will be applicable, and then comparing that with a savings rate. Okay, so that's all the ingredients or data points that go into this calculator. And so if we look at it from a monthly budget perspective, we know we're paying $2,200 a month in rent. If we were to compare that to owning, our ownership expense goes up to $3,900 a month. So that's what my budget would look like if I bought a $450,000 home. Now, where the opportunity lies for us as future home buyers is when we stack in and look at the appreciation rate of my home, potential tax deductibility of owning, comparing that to renting versus maybe paying my landlord's mortgage, right? I have about a $60,000 opportunity of owning a home versus just continuing to rent for the next 7 years. And that's a big difference for many of us when considering ownership. So again, I would not, when I look at budgeting for homeownership, I wouldn't consider it an apples to apples comparison because all of those ingredients that make up that $60,000 opportunity over those next 7 years. Now, everybody's situation looks a little bit different, whether your rent's a little bit higher than what we projected, or maybe you're thinking about buying a cheaper home. But at the end of the day, those ingredients still look the same, or the characteristics look the same of the opportunity of owning versus renting. I would encourage you guys, if you have some time after tonight's class and you get our presentation material, try to run that calculator yourself. I think you'll find it very enlightening as you kind of consider homeownership for one of your future financial goals. For those of you that put your location in the chat, thank you for that. So I made the assumption we were all in the DMV area, which was not the case. So thank you for those that are that put that information. That's super helpful for us. So when we get to our market data, then we can certainly kind of talk a little bit about specific markets. And in fact, we're going to dive into it in just a second. I did get a question in the chat about sending the calculator link. We will get that out. That's actually going to be sent to you as part of the presentation material tomorrow. Ken just went, one of my colleagues put it in the chat as well. So if you want to access it now, feel free to go ahead and do so. Let's talk a little bit about the Virginia housing market. And I know some of us are looking at different markets, but I think let me just give you some overall kind of commentary on the markets. And then we'll kind of look a little deeper in Virginia. For most markets across the country, this is the busier time of the year because spring and summer months lead to warmer weather. So it usually will get more buyers active in the market. It also brings more sellers to market. We've had some pent up demand over the last 2 years for more inventory across the country, namely because most sellers that own today don't necessarily want to trade out their 2 and 3% mortgages for today's market rate and then go out and upgrade their home. So we've had some inventory challenges across the market. We have seen new home builders that are trying to supplement, the gap, if you will, from between demand and inventory, but we still have some challenges. Although things are starting to improve a little bit across the market, we are seeing at times in certain markets, we are starting to see a bit of a slowdown in terms of how quickly homes are coming off the market. We've seen markets like Florida, Colorado, Texas, and Georgia, to name a few, that are seeing a little bit longer inventory time. So we're seeing homes stay on the market a lot longer. So it's obviously building up a little bit of supply. So we'll have to see what happens from a price perspective in those particular markets. I don't think we have anybody looking in those markets from what I saw in the chat. But ultimately, I think we are seeing some changes in our housing market. And we'll be commenting this on video tomorrow, but we might see a more of a buyer's market starting to emerge across most parts of the country, which means buyers may have the upper hand because now with inventory sitting a little bit longer than what we've seen 2 years prior, buyers can have more choices. But that can change quickly, especially as we look at interest rates, which we'll talk about in just a second. Now, if you look at specifically at the Virginia housing market, you're seeing a little bit of an uptick in prices here. Some of that's just simply based upon supply that's out there and kind of what we have in buyer demand. You can see our median sales price. But right now, this is the busier times of the year. So April till about August, September, we see kind of more activity in the marketplace just because, again, warmer months. We also see families that are trying to transition into certain school districts. We might also see employers that are relocating employees out to a certain area. But I would say from an overall housing perspective, while we have some uncertainty in the economic markets, we are seeing some positive trends for buyers that are trying to enter the market. Last thing I want to comment on here is we saw a stat that came out just last week, which indicated that 44% of all transactions being done across the country had some type of seller concession involved in them. And that means, price cuts, or maybe it's the seller crediting back money towards closing costs to make the transaction more affordable for the buyer. So that's something we certainly haven't seen in the prior 2 years. So that would also give some encouragement that maybe we are transitioning to more of a potential buyer's market. Let's talk a little bit about interest rates. And I know I got a question that came into the chat, and we'll kind of comment on that as well too. But ultimately, when we look at interest rates over the last 12 months, and we've seen a little bit of a bumpy ride here, so to speak. You guys can see this referenced by this blue line here. That's kind of what we've seen with the 30-year fixed mortgage in the last 12 months. Just about 3 weeks ago, we saw a little bit of a sliver of window of rates dropping to the best levels of 2025. That was quickly erased by kind of elevated concerns around tariffs, and we're still kind of having this back and forth on the impact of tariffs into the economy and what that could do, right? So there's still a lot of uncertainty around that, even though we have a pause on tariffs. I think it's a 90-day pause, if I'm not mistaken. There's two other elements that are playing a role in interest rates right now. One is inflation, obviously the cost of what we're paying when we go to the store or fueling up our cars, that kind of stuff. Also, we're looking at what the labor markets are doing. So the Federal Reserve has a mandate to get inflation to 2% and then have a controlled or improved labor markets. And so we're still a ways away from the inflation goal. I think we're still running around 2.6% in inflation. But the reason why interest rates are elevated today is a result of the Federal Reserve elevating the federal funds rate in order to combat inflation. Now, as we inch closer to that 2% goal, we should see interest rates to start to fall. We probably won't see a lot of movement south in interest rates until we move into next year. We're still going to probably remain at these elevated levels that we see here today, which is in that high sixes position. But I don't think it's a question of if interest rates are going to go lower. It's more of a question of when. Now, a question that came in the chat, which was, how would a potential recession affect home supply and demand? Well, in the housing market, when we see a recession, generally that means interest rates go lower. So from an interest rate perspective, that would actually mean a good thing, from an affordability perspective. Now, what it does to the housing inventory, we'll have to see. I mean, recession could lead to some distressed sales. If employment numbers really go off the charts, where we have some unemployment, I should say, then we could have displaced workers that can no longer afford their homes. That could impact inventory levels. But generally in a recession, interest rates go lower, which can be better in the financial industry space, at least from an affordability perspective for buyers. Now, what I've encouraged buyers to think about is, with this uncertainty in the markets, if you are positioned to buy relatively soon, it could lead to opportunity in the market. Now, while interest rates aren't at the most convenient levels, it still could present an opportunity if you could afford to enter today's market. Now, before we leave the interest rate topic, I just want to quickly give you a snapshot of what does it look like over the last 20 years of interest rates. And so going back 20 years from now, interest rates look very similar. But of course, housing prices were significantly less back 20 years ago. But the housing market and interest rates will cycle over time. The other thing I just want to kind of quickly make note of before we move on is to talk about, the pandemic of 2021 and what that did to interest rates. Because I get the question a lot is, are we going to ever return to 2.5% and 3% interest rate levels, which you can see here on our chart? Hopefully not, right? That means we've gone through a major global crisis if we return to those interest rate levels. And so that was a complete anomaly. That's the lowest level we've seen in interest rates. But I think historically speaking, when we kind of look at interest rates, 4.5% to 5% is really an historical average. All buyers, of course, want the best or lowest interest rate. They want the lowest priced home. It's really difficult to find that perfect storm. But certainly, we're here to help educate you on what that interest rate climate looks like for you in your personal situation. Now, every interest rate is not the same for all buyers, and I think that's important to understand. Things like credit score and your overall eligibility for a product go into the interest rate, what program I'm going to select, what my financing or how much I'm going to finance looks like. We talked a little bit about the minimum down payments, but the down payment percentage can influence your interest rate. Discount points also can play a role in interest rates. So if I decide to put more money out of pocket to bring down my interest rate, that is one tool or mechanism to bring down your rates through points. And then the loan term can also lower my interest rate. So traditionally, especially for most first-time buyers, we're going to elect a 30-year fixed mortgage. But if I decide to condense that term to 20 years or 15 or 10, that can also lead to a lower interest rate opportunity. Now, as we get a chance to connect with you for a consultation, we're going to figure out which best suits you in terms of with your financial goals around homeownership. How can we best construct your home buying options? All right. Okay, now we're going to kind of transition now. I want to talk a little bit about credit, and credit's one of those important things that we have to cover in our home buyers consultations, because ultimately we want to create opportunities for you in home ownership and help you better understand ways of improving potentially your credit, or maybe just better understanding how we can maybe optimize your credit score. So I think it's important to first of all understand that every loan product does have a minimum credit score requirement. Now, we put some of those loan products up on screen. Usually the lowest credit score to get obtained financing would be a 580 credit score, which would be for our FHA home loan product, which we'll talk about guidelines for that product in just a second. We're going to do some discussion around looking at the overall mortgage credit score. Now, there are 3 different scoring methods to credit scores. There's the credit card model, there's the auto financing model, and then there's the mortgage model. Now, for those of you that monitor your credit, which is most of our attendees for classes like this, you're probably using the credit card model. So if you have Credit Karma, for example, they're using the credit card model. Now, the reason why I point that out is because that model will look a little bit different than what we look at in the mortgage side of things. So you might see a little bit of a different credit score in comparing those 2 methods. And like I said, I'll show you that in just a second. In our credit discussion, we're going to talk a little bit about, the impact of major events in your credit score, like late payments, maybe a bankruptcy, how those impact your credit score. We are going to spend some time looking at credit utilization. How do we manage revolving debt? So when we think about credit utilization, we're comparing credit balances versus what the credit limits look like. We also look at account closure, like looking at how long I've had my credit file open. That's really important in terms of maximizing or optimizing your credit score. Now, in lending, we look at all 3 agencies' credit scores. Now, you guys know all the credit agencies, right? Experian, Equifax, and TransUnion. Each one of those agencies has a different risk scorecard. And when we look at those credit scores, we take the middle score of all 3 bureaus. So if my top score is 760, my middle score is 740, and let's say my lowest score is 720, we're going to use 740 as a score for qualifying for that particular scenario. Now, if my partner is going to join me in my loan application, and let's say my partner is at 720, 700, and 680, well, we have to look at the lowest middle score between both borrowers. So in that scenario, if my partner is going to join me for the application, we're going to use the 700 as the score. And that's important to understand, because as we build your financing scenario or home buying plan, that lower credit score could influence your interest rate, which of course impacts your monthly payment, could affect the product that you're eligible for, even mortgage insurance costs, which you're going to learn a little bit more in tonight's discussion. Now, if you've had any past challenges or negative items on your credit report, I just wanted to pass along this matrix to you that kind of shows you how long those items will stay with you on your credit report. Now, let's talk a little really quickly about this item, which is credit inquiries. So a credit inquiry is essentially a hard inquiry that can impact your score, especially in the most recent 12 to 24 months. So you really want to avoid inquiries on your credit that are hard inquiries. Now, there's a rule in place for mortgage lending and auto lending that once I make an inquiry today, that starts day 1 of my 30-day window, and I can shop around with as many lenders as I want to for auto or mortgage, and it's the equivalent of 1 credit inquiry hit to my score. Now, in our no obligation consultation we do with all of our clients through our partnerships, we only start with a soft credit check. And the reason why we do that is because a soft credit check does not impact your credit score. And that's a really important element into buying your home buying or into your home buying plan, because we don't know how long it's going to take for you to find your home. And so we want to provide you all the options and resources that you need for home buying without necessarily impacting your credit score. Now, let's take a look at what the FICO score calculation looks like as it relates to the mortgage side of things. So I kind of hinted at this a little bit earlier, but the length of credit in my credit score has a 15% weighting in the credit score model. So the longer my credit profile is, the better my credit score is going to be. So if I decide to close out a credit card, for example, the drawback with that is that once I close out a credit card account, it takes away all the history from my credit file. So we really want to be mindful of that when we're thinking about closing out a respective credit card. Now, the next component is how much new credit am I trying to obtain? So it goes back to our conversation around hard inquiries. So we really want to avoid hard inquiries. And then opening new accounts. So when I open up a new account, it can pull away from my credit score a little bit. That's 20% of the weighting. And then the biggest area of opportunity for most first-time buyers is looking at credit utilization. What do my revolving balances look like on credit cards and personal lines of credit versus what the credit limit looks like? So if I have $5,000 in balances, I'm at $10,000 on my limits. Right now, I'm at 50% utilization of those resources. If I just booked a trip to Cancun and all my balances are at 8,000, right? Then now I'm at 80% utilization of credit. What I would encourage that client who has that $8,000 balance to do is try to whittle that balance down to 50% utilization. Once we've gotten to that level, now our next step is to get to 30% utilization. And if we're trying to really optimize our credit score, let's get those down to 10% utilization of credit. All right, last component to the weighting of the credit score model for mortgage is payment history. And so that's simply looking at, how have I paid on my credit card or my credit bills? Now, if I've had a late payment at all, it's rated as 30-day lates, 60-day lates, and then 90-plus day delinquencies. Now, the more severe I'm at on the delinquency scale, so if I'm at a 90-plus day delinquency, that's going to be more significant in the impact to my credit score versus, say, a 30-day delinquencies. Especially if I have an event like a 90-day delinquency in the most recent 12 to 24 months from the credit pulling, then I'm going to probably see a pretty big takeaway from my score. But as I move further and further away from that event, then my score should kind of organically go up. All right, we're going to talk about student loans next. I'm getting a few questions that are popping in, so I just want to answer a few of those before we talk a little bit about student loans, because that kind of dovetails into a little bit about our credit discussion. So one of our questions was, when would it be advantageous to get a shorter term mortgage, for example, being less than 30 years from retirement? Mortgages and the terms will vary based upon obviously what your goal is from a monthly payment perspective. Clearly, if you take out a 30-year mortgage versus a 15-year mortgage, that 15-year mortgage is such a significantly higher payment. It really just will depend on what kind of your financial goals look like. Like you said, in your retirement, if you're trying to pay off your home by the time you retire, then if that's a goal, then let's figure out how to design some options around that. But keeping in mind that, it's obviously, we have to be mindful of what's that monthly payment going to look like. All right. Another question was, have you observed the 3 credit agencies moving towards incorporating timely rental payments in scores? So you can report housing payment history like rental history to your credit bureaus. Now, I don't know if it's impacting necessarily the score. I'd have to look kind of a side-by-side comparison, but we are seeing clients that are doing manual reporting, if you will, for their housing history for rentals. Now, Experian, which is one of the credit agencies, has a program called Experian Boost, which allows you, if you have limited trade lines on your credit report, to report things like your rental history, even like things like your utilities to your credit report, which can help to establish some type of history. So, if you do have limited trade line history, I would encourage you to check out Experian Boost. That could be a nice little resource for you. And then one other question before we move into student loans, and then we'll kind of keep it moving, which is, are there rules to renting out my first property? So there are rules if you're doing a first-time buyer program, but if you buy your first house, and let's say you're doing it traditionally without any assistance programs, you usually have to be in that home 12 months before you decide to rent out the property. Okay. Let's talk a little about student loans because it does come up in my conversations with clients in building home buying plans. Now, if you have federal student loan debt, it's probably in a forbearance status because they're still trying to sort out litigation to forgiveness of debt, of student loan debt, I should say. We're hoping to see resolution on that sometime in September or October. I think it's important to understand that regardless if you're in forbearance or any type of deferment scenario with your student loans, as a lender, we're still going to have to count a minimum payment when it comes to qualifying for your home financing. Now, if you're in an active repayment, you're not doing an income-based repayment program right now or any type of deferral, and you're paying on your loans, then we can still use a reduced income payment program. So that's completely allowed. So if I had $75,000 in student loan debt and I was paying $250 per month on that payment program, we can absolutely use that. So we see that a lot in the savings programs, or the save plan, I should say, for student loans. Now, if you're still on forbearance and you're not making active payments, then by default, we have to take a minimum payment for qualifying purposes. So if I was doing an FHA loan, then I would have 0.5% of the balances that I would use my payment. So if I have that same $75,000 in debt, then we would use $375 as the payment for qualifying. If I was doing a conventional loan, so a Fannie Mae type loan, then I would use 1% of the balances, which would of course would be $750 for qualifying. So just wanted to kind of share that with our class tonight, because student loans obviously do come up in our conversation since we work with so many alumni associations across the country. And so understanding kind of how that impacts the qualifying, I think, is really super important. And we'll talk more a little bit about that. If you have any more questions, you can certainly drop those in the chat or the Q&A. But the reason why we do have to uncover what's going on with student loans is because every loan program that's offered by us as a lender has guidelines that we have to adhere to. And so now in our discussion, I want to talk a little bit about, as from a high level perspective, like what these programs look like and how can they apply to me. So the first product type is a conventional home loan. So that's either a Fannie Mae or a Freddie Mac loan. You might have heard of that terminology, especially going back into 2008 and 2009 in the housing crisis. Fannie Mae and Freddie Mac was front and center. But those agencies occupy about 60, maybe 70% of all origination of loans across the country. The conventional loan product for first-time buyers has a minimum down payment of 3%, usually a minimum credit score of 620. And then every year, Fannie Mae and Freddie Mac, or FHFA, set the conforming loan limit for the lenders each year based upon cost of living. It's 806,500 this year. So that's the conforming loan limit. Now, in other parts of the country that are deemed high cost of living areas, like let's say you're in New York or you're in some of the markets in California, you may be able to finance more than 806,500. In fact, in LA County, which I don't think we have anybody from LA in tonight's class, but you can finance up to $1.2 million under a conventional loan. Now, when we elevate above the conforming loan limit, the minimum down payment jumps from 3% to 5%. Now, anytime I put less than 20% down on a conventional loan, there's a thing called private mortgage insurance. We have a section in just a few minutes that we're going to go through and talk a little bit more about what mortgage insurance means to us as buyers. The next product is the FHA home loan. That's a Federal Housing Administration loan. It is a government insured loan, has a minimum down payment of 3.5%, minimum credit score of 580. And the loan amount's a little bit different. It changes based upon where I'm going to buy in the country. So whatever county I'm going to look at, there's a set loan limit by FHA. Now, with some of the administration changes and what's going on with FHA loans, there has been some updates to guidelines for both the FHA loan and the USDA loan. So effective next month, anyone that's a non-permanent resident does not have access to these two programs. Unfortunately, that was a guideline change that we would been made aware of about 2 or 3 weeks ago. That will go into effect in May. However, if you're a non-permanent resident, you can still get access to the conventional home loan product. So unfortunately, that was an update that will be implemented next month. Now, the next product is the jumbo home loan product. That it really is going to be probably for most buyers, the second or third purchase is probably not for most first-time buyers, but ultimately is a resource for you. Minimum down payment of 10 to 15%. Credit score minimum of 700 usually, and it essentially allows buyers that maybe are buying in a market that need to stretch beyond what maybe the conventional home loan products can handle. The next product is the VA home loan. So that's for our veterans that have served and have eligibility for the VA home loan product. It's a 0 down payment option, minimum credit score of 620. There really isn't a maximum loan amount. In fact, with VA, you can go to $5 million, believe it or not, in loan amount with a 0 down payment option. And you have to be obviously eligible veteran for that product. And then if have any partial disability from the VA, there's a thing called a VA funding fee that you're exempt from if you have any type of partial disability from the VA. For other veterans using the product, usually they charge a VA funding fee, which is 2.15% of the loan amount. And then the USDA product, I mentioned a little bit more about the eligibility, but ultimately the USDA product is for clients that are looking to purchase in more rural areas. And it's 100% financing, so it does have a zero down payment option, minimum credit score of 620, and then the maximum loan amount depends on where you're going to purchase using that product. There's really two qualifiers to USDA. There's maximum income limits by household size, and then of course the location. It has to be deemed a rural area. All right, so we had a question in the chat, and then I'm gonna, or the Q&A, I should say, and then we're gonna talk a little bit about PMI to keep us on track here. So the question was, my spouse and I recently accepted new jobs with much higher salaries than we currently make. How does that impact the mortgage approval, pre-approval process? So great question. We actually uncovered that in our income section, but since we're here now, let's talk about it. So what's nice about in qualifying for financing, if you've recently got a new job offer, we can actually qualify you with that new job offer or offer letter. And so that can be factored into your overall qualifying for financing. And then we just have to make a determination on when you're going to start that job. And then ultimately, once you start the job and you get paid your first paycheck, then we, as a post-closing item, get a copy of that that first paycheck. So yeah, so it can definitely happen. So and we'll cover that again in our income section, but thank you for the question. Let's talk a little bit about mortgage insurance. There's really two forms of mortgage insurance. There's PMI, which is known as private mortgage insurance, and there's MIP, which is a mortgage insurance premium for an FHA loan. So let's kind of dive a little bit deeper into each one of those products. So with a conventional loan, anytime I put less than 20% down, I'm going to have mortgage insurance. The mortgage insurance is scaled based upon down payment, credit score, and how much I finance. So the more I put down, the higher my credit scores, the lesser my mortgage insurance can be. Now, mortgage insurance or PMI on a conventional loan has a cancellation option. So once I have 2 years in my loan and 20 to 22% equity, I can apply to have my mortgage insurance canceled. Okay, so that's one of the bigger benefits with conventional loan products. Now, if some of us in class have already started our home search and we're on Zillow or Redfin, maybe you've used some of their calculators online, I wouldn't necessarily rely on some of those calculators because the premiums that show for PMI don't necessarily match to what they actually are because they're not really calibrated to some of those factors I shared with you earlier. There's about 7 to 8 different PMI companies across the country that we partner with. So, you know, it looks almost very similar to car insurance. So we can kind of shop around for the lowest deal, but ultimately it's based upon down payment, credit score, and amount finance. So if we looked at a client that was, let's say, financing $450,000, they had a credit score of 740, and they were putting 3% down, that PMI is probably around $138 a month. Now, if I can elevate that credit score higher, I can put more money down, then maybe that mortgage insurance goes even lower. Now on FHA, so the Federal Housing Administration loan, it is a government insured product. So there's two forms of mortgage insurance. There's monthly mortgage insurance, which is calculated at 0.55% of my loan amount. And then there's upfront mortgage insurance, which is 1.75% of my loan amount. Now that 1.75% gets added into my total amount financed. So my balance is going to be a little bit higher when I use the FHA product. With FHA, there is no cancellation option in the mortgage insurance. So the only way for me to exit mortgage insurance is if I refinance into a conventional loan. And that's what happens most often for clients using FHA. FHA, from my perspective, is going to be more of a temporary solution where it allows me to have an entry point to homeownership for my clients. But then as things change, maybe my credit score goes up, maybe my income's a little bit more stable, then I can switch over to a conventional product. In fact, we have a client this week that's using that used the FHA loan 2 years ago to buy his house and now is refinancing to a conventional loan because his income has improved and his expenses to income look a lot better. So now he can move to a conventional product and save himself a lot more money. So FHA is going to be a great tool and resource for us in home buying if we need it, because ultimately it's going to provide a little bit more flexibility in qualifying than what we might see on the conventional product. Now, from a numbers perspective, if we took the FHA MIP scenario, we have our same 450 loan amount. We have to add in the upfront mortgage insurance, which you can see here. And then we have the monthly mortgage insurance. So a little bit of a higher expense structure on the FHA loan as compared to conventional. But again, it may work for a client that needs that resource, maybe because we have some challenges from maybe a credit score perspective, maybe expenses to income. There's a variety of different reasons. Ultimately, we're going to tailor or customize the right home buying solution for you based upon your goals and objectives for home ownership. So question came in the chat was, do I have to pay an upfront fee with private mortgage insurance? And the answer is no. So let me just go back for a second. So there are different ways to pay PMI. You can pay it up front. You can also build it into your financing, like in the cost of your interest rate. Like you can take an elevated interest rate. You can also pay for it out of pocket and just completely buy it out. We recommend doing the monthly mortgage insurance option because that's what most clients do, but more importantly, because it does have the cancellation option attached to it. All right. All right. Thanks for the questions. All right, let's talk a little bit about income. I know we addressed a few questions already, but I want to kind of give you a little bit of a closer look into income because it certainly is a conversation we're having with clients as we're building their home buying plans. Now, I want to point out for you just some of the documentation needed as you're starting this journey towards homeownership. We generally would need some of these items here. If you're self-employed, we definitely need to see 2 years of tax filings. For W-2 employees, at least the last 2 years of W-2s, recent pay stubs for the last 30 to 60 days. From an asset perspective, we usually look at the last 60 days of bank statements. We'll talk more about assets in just a minute, but I want to kind of just uncover a few things around income. One of those was we just talked about is you can potentially apply for home financing, get qualified and pre-approved, even using an offer letter. So if you're transitioning jobs, you can absolutely do that. We have to look for a 2-year work or educational history when it comes to financing. So, if I just graduated from UVA in the fall and now I'm in the workforce and I just started my job, you can still potentially qualify for home financing because I can use your education as part of that 2-year requirement, even though you might have only been on the job for the last, 4 months or so. Now, so those are definitely options for you as a home buyer. Now, if you're self-employed, we do have to see that you've been on your job or have your business, I should say, for 2 years of tax filing period. So that's kind of like, that's a mandatory thing. So you don't have to necessarily be on your job if you're a W-2 employee consistently for 2 years. You could be there for 2 months and still be able to get qualified for financing again. We just have to look at the last 2 years of work or educational history. Now, if I have dual employment, so let's say I work for 2 different employers because I'm in maybe the medical industry and I work for one employer for 30 hours a week, another employer for 15 hours a week, right? If I want to count both sources of income, then I have to show that I've been on both jobs simultaneously for the last 2 years in order to count those into my qualifying. All right. Now, another thing that comes up often is maybe I'm just going to apply in my name, but my partner contributes to the household income and expenses, but my partner's not electing to be a part of the financing. The only way we can introduce that income for qualifying is if your partner is also going to join you as a joint applicant into the financing. So the income that's going to be considered for your loan application has to be all documented in the application. And the last thing I want to kind of touch on here is, unless you guys have more questions on income, is looking at supplemental income sources. Like, let's say I drive for Uber or Lyft on the weekends when I have some free time. Now, I get paid that income as an independent contractor, but if I want to introduce it to my financing scenario, if I have a W-2 job for 40 hours a week, plus I drive, then I have to show that I've been on both jobs simultaneously for the last 2 years. All right. So that's kind of what that would look like from an income perspective. And I'll take, of course, any questions you guys have around income, but we also look at expenses versus income. We call this calculation debt to income ratio, which takes into consideration my existing debts that I have today. Maybe it's credit cards, personal loans, car financing, right? And then we also factor in the housing expense that you're going to have, which would include the principal and interest of my mortgage, my property taxes, my homeowner's insurance, even mortgage insurance if I decide to put less than 20% down, let's say on a conventional home loan. If I've elected to buy maybe a condo or maybe a townhouse, I would want to factor in homeowners association fees that would be part of that. So that would all go into our housing expense budget plus those other debts we have. And essentially as lenders, we look at those expenses, housing plus your existing expenses, compare that to your pre-tax income. And so we've kind of built out a little bit of a calculation here for you below. You can see your principal and interest. So PITI means your principal and interest, taxes and insurance for your home, PMI if we have that, HOA expenses. And then we look at that being at $2,500 a month. And let's say we have $500 in other expenses. So in this scenario here, we have someone that has $3,000 in expenses versus an $8,500 a month income. So we would look at that debt to income ratio at 35.3%. Now, the highest we can go in financing is usually 45 to 50%. Now, there's various levels that we would say, would be kind of be ideal or comfortable for most clients. We say 33 to 36% seems to be a pretty good range for most clients, but certainly the underwriting guidelines allow us to go up to higher levels. Like I said, 45 to 50%. I would say 33 to 36% seems to be kind of the sweet spot for most clients, but it's most important for us to understand more about your affordability for homeownership. So even though I might qualify for a much higher payment, when we design options for you, we're going to be really targeting what's affordability look like for you. All right. So that's called debt to income ratio. And again, that just measures from a qualifying perspective. And we had a question pop in before we go into more about savings for homeownership. And that is, and this question is, my partner is a grad student with minimal income, but has savings to put towards the down payment. How would that work, generally speaking? So that happens quite often. If you have this kind of the main source of income, there's a couple different things you could do. You could, apply just in your name, and then your partner could gift you funds for the home purchase. So the assets that person has can be used more towards the down payment and closing costs. Or, we can have both of you apply together. There's not a set minimum amount of income for qualifying. We ultimately just have to view credit scores and overall qualifying. So we would essentially blend together your income versus expenses to determine the total debt to income ratio. All right. All right, thank you for that question. All right, let's talk a little bit about savings, and then we're going to kind of round out tonight's discussion looking at the buying process as well, too. So we're doing great on time, so hang in there with us. Let's talk a little bit about the savings, the idea of savings around home ownership. And when we think about home ownership, it's probably going to be one of two challenges for most home buyers. One, it could be just because of the credit side. Maybe we're a little overextended. Maybe we booked that trip to Cancun and we were not quite ready for home ownership. Or it could be we just haven't got enough resources together from a savings perspective. So I want to do a couple things in our savings section. Is one, kind of share with you how we document assets for the home purchase. For example, we just had this scenario of a partner that's going to contribute towards the home purchase. We would call those gift funds, where a relative or partner is contributing assets towards the home purchase. That's completely allowed in your home buying plan. Those type of assets do not require any type of seasoning requirement, but other assets that I've been saving up, or maybe I'm accessing from a 401k or 403b, would need to be seasoned at least 60 days. So that's a requirement in home financing. Now, if you're choosing to use a 401k or brokerage account, I would always encourage our clients, talk to your tax or financial advisor. Just make sure that's the right financial decision for you before moving forward with those type of assets. Now, as you're building up kind of that asset situation for home buying, it can be a challenging component for most of our clients, because maybe we're just getting started in our careers and we just haven't quite got our arms around saving enough for home ownership. So I want to give you a really simple approach to saving in tonight's class. And it looks like this. So if I'm renting for $1,500 a month, but after meeting with Jason for a home buying plan, and we've kind of put together a roadmap, we think the projected budget needs to be at $3,000 a month. Well, right now we have a $1,500 gap from where I'm paying today versus what my projected mortgage payment looks like. And so if I'm really lacking savings, I would encourage our client to do this. On the first of the month, when you make that payment to your landlord, create that habit of now paying $3,000, but $1,500 is going to your landlord. The other $1,500 is going right to your savings account at the first of the month. And it does a few things. As you can imagine, it's creating that savings for you, but it's also creating that discipline for yourself that you're in the habit of making that $3,000 a month payment. So it's not such a payment shock when you jump into homeownership, because you've been paying that $3,000 a month. And of course, the savings is growing, right? After 6 months, you have $9,000 saved up. By the end of the year, maybe you have $18,000, not including interest that could accrue on a high yield interest bearing account. So that's one approach to kind of closing the gap when it comes to savings for homeownership, because we understand it can be a challenge, especially in a market like this. Now, there are first-time homebuyer programs that are offered all across the country. I know we're in different parts of the country. I think I saw Chicago represented, and Ohio, and then, of course, the DMV area, maybe North Carolina, I think I saw too. So there are programs very similar to what I'm going to describe to you that's in the state of Virginia that can be offered to you as well. It's usually centered around low to moderate income buyers. So, we don't have time to go through all programs across the country in tonight's discussion, but I would encourage you to get connected with me after tonight's class, and I can walk you through some of those resources that are available to you. Now, in Virginia, there is a few programs offered through the Virginia Housing Office, which would include the Virginia Housing Conventional Loan, designed to support lower cost, essentially, for first-time buyers. There is a down payment assistance grant, which provides up to 2 to 2.5% of your sales price in assistance. There's also resources through the Virginia Housing Plus Second program, which essentially allows you to borrow up to 3 to 5% in assistance. And that essentially goes down towards reducing your out-of-pocket expense, things like down payment, as well as closing costs to purchase your home. So there's a lot of great resources out there. And I think when I meet with clients across the country, they think homeownership is this like 3 to 5 year goal. But when we look at and take a closer look at first-time buyer programs in your applicable market, homeownership can be such more of a near-term goal for you for sure. Now, we also have another product that's FHA only, but it's a nationwide product. It's called the Pathway Program. On an FHA loan, it provides up to 3.5 to 5% of your loan amount in assistance as well. So hopefully your takeaway here is there's a lot of great resources out there for first-time buyers. So, we want to provide encouragement for you that you can be on the path towards homeownership so much more closer or quicker than you might think. Now, let's talk about what that path towards homeownership looks like. And so I want to walk you through the buying process of owning a home. So after you leave tonight's class, we would love to get connected with you for a consultation. A consultation is where we basically meet with you for a 30-minute video session to design a comprehensive home buying plan for you. And the cool thing about it, we only do a soft credit check, and it's a no obligation opportunity. So if you just want to build the basic framework to home buying, and you don't know if you're going to buy now or buy later on, we want to help be a partner for you in that. So after we complete a consultation, that kind of gets us on the 6 steps of home buying. One is the output of that consultation is to be pre-approved for your home purchase. And a pre-approval essentially tells you as a buyer, this is what I'm approved for, and then allows you to go out and confidently make offers on homes to a seller. Generally, the pre-approval is good for 60 days, but that pre-approval can be recertified at any time. The pre-approval, which is a question we had in the chat, is not like location specific. So we usually have it marked as TBD, so to be determined. So, and of course, it'll be kind of based upon the generality of like what city or community you want to purchase in, but not specific to any type of address. That pre-approval essentially gets updated as you go through your home search, which is ironically step 2. So that's the house hunting phase of the buying process, where you're out and hopefully partnering with a local realtor that's going to show you options that essentially will kind of target the type of property you're looking for. A realtor that you partner with should be an expert in that community, have some really great partnerships or relationships to introduce you to buying opportunities, should be an expert in negotiations, and also has inspector companies that can help support you as you take those next steps in kind of reviewing a particular property. Now, if you find a property that you love and you want to write an offer on that property, the realtor will help kind of orchestrate that for you. Now, then they'll submit that offer to a seller. If the seller accepts your offer, then you move to the next milestone, which is step 3. That means the seller has accepted your offer, and now it kind of begins the real processing of the loan. Now, the same day that offer acceptance transpires, you're going to get a call from me directly saying, hey, congratulations, you did it. This is probably one of the biggest steps, is just getting an accepted offer. But congratulations. And let me walk you through what next steps are going to look like. And that includes doing a follow-up consultation with me to make sure that your financing is designed properly. You understand the climate of interest rates, what your out-of-pocket expense looks like, what the monthly payment's going to come out to. All those important things will happen during the follow-up consultation. And we kind of give you a comprehensive summary that matches up to what we've discussed in that session. We're also kind of let you know a little bit about next steps. And so that will include kind of what's going to transpire with the processing of your loan. Now, you as a buyer will have some action items through the escrow company or attorney's office that we're working with on the transaction. There's an earnest money deposit, which is essentially a good faith deposit that you make as a buyer in the transaction. Usually that deposit is 1 to 2% of your purchase price, and it counts towards your total out-of-pocket expense. Now, that deposit is generally protected in most parts of the country through some contingencies that are in the real estate contract. Those contingencies allow you to do your investigative work on the property, like get the home inspected, get your appraisal done of the house, which me as a lender will order for you, and of course, get your loan approved. And those are really important elements to the contract because it essentially protects that deposit. So if something goes a little bit of awry in the transaction where maybe things don't quite check out the way they should be in inspection reports, you could potentially pull out of that contract and get a full refund of your deposit. Now, step 4 is the processing of the underwriting of the loan. That happens after our follow-up consultation we do with you. Our team now starts to verify things like employment, assets, make sure that the program is situated properly. Now, interest rates on products can change daily, as we mentioned earlier in tonight's class. Once you're under a contract with the seller, then we're strategically watching the market to hopefully time the market for the lowest rate option that we can offer for you, in addition, of course, to your UVA alumni discount. So, there's a little bit of a timing mechanism to locking in the lowest available interest rate when it really comes to being under the processing phase of the process. And then at step 4, we then submit everything to the underwriters who will essentially approve your loan for the financing. Now, the underwriter reviews income, assets, credit, all of that stuff, and checks to make sure everything matches properly in your loan. That also takes you to about probably 2 to 3 weeks in the process. At that time, once we have loan approval, we also have the appraisal back on your house. And if everything checks out from an inspection perspective, then you're going to sign off on your contingencies. And that essentially tells the seller that you're ready to move to the closing phase of the process. And part of that closing phase includes us delivering to you a final closing disclosure that essentially gives you a 3-day cooling off period before we move to the very final milestone. It's called closing your loan. And on that day, you're going to be signing final loan documents with a public notary. The wire, you will be within wiring in funds that you have as your contribution towards the purchase. And us as a lender also will be wiring in those funds. And so those funds that are sent in get balanced out to ensure everything is properly set up for you in your home purchase. You've contributed what you're supposed to as a buyer, sellers receiving the funds that they expect. And then documents get recorded with a local county recorder's office. And that essentially is the finalization of the home purchase. Basically says that now you're become the owner of the property and everything is completed. And that's a great day for you to celebrate. And we want to be there right there with you. Every time we get a chance to bring the good news to a client, you're going to get a call from me saying, congratulations, you did it. I got a chance to make a couple of those calls through some of our partnerships earlier today to say, hey, guess what? You get to get the keys to your house today. It's a huge day of celebration. And, our relationship doesn't stop there with our clients. As part of our relationship, we have an aftercare program. So, as your ownership changes in your home, as your home appreciates, we're going to be monitoring, rate activity for you through our HomeBot and Rate Watch system. And we always check in with our clients on an annual basis because we understand things change financially in the seasons of life, right? So whether this is your first time buying or you're looking at buying the second time, we want to make sure that we're here to support you with any resources you need on that journey. That's kind of what it looks like from a process perspective. And we're getting ready to kind of wrap up tonight's class. I know I got some questions that I'm going to answer for the group, but I just want to kind of explain to you how do you get started in the process. And so this screen kind of shows you taking the next steps in home ownership. So if you're interested in kind of figuring out what home buying might look like for you, we provided our get started information here, which is a really simple online application process. Remember, we only do a soft credit check, so you don't have to worry about your score being impacted. You'll upload some documents and then use our scheduling system to schedule a video consultation where you and I get a chance to meet to develop a plan for you. Now, if you have some general questions after tonight's class and just want to get connected with us, I'd encourage you to schedule one of these introductory calls. Maybe you just want to kind of answer some questions about maybe the first-time buyer programs or maybe some general income questions. Feel free to use that introductory call option as well too. The comprehensive consultation is really a great starting point towards home ownership for you. We're going to dive a little deeper into where do you want to buy, what's your budget look like, uncover maybe some credit opportunities for you. Also look at some first-time buyer programs. So I'd really encourage you to take us up on that no obligation opportunity. I think it'd be a really great opportunity for you. Well, I appreciate everybody hanging in as we wrap up our class. We're almost to the top of the hour. I want to point out one of our resources to you on mobile. This mobile tool can start the application process for you. You can use the calculator function. Maybe you're at an open house over the weekend. You're like, hey, what's that payment going to be for that house? You can use our mobile feature for that. And it also will push notifications for you as you move through the home buying process. Well, again, as part of our UVA alumni partnership, you get a discount in your services and working with us for either a home purchase or a refinance. Of course, our classes are available throughout the year. We got 2 more classes left on the agenda with our UVA Alumni Association. Really excited to bring this again. If you have friends or family or coworkers that might enjoy this content, we'd encourage them to check it out. The list of all of our upcoming classes can be found out at mortgageeducate.com. And here's all my contact information. So if you have some questions for me, don't hesitate to reach out. We have a few questions in the chat. I'm just going to answer these. I know everybody's kind of sticking around. I appreciate everybody, staying in tonight's class. Hopefully you've enjoyed it. Again, we're recording tonight's class, so in case you had to step away from your computer or whatever, you'll be able to see everything up on our YouTube channel tomorrow. And so the one question I did have, which was, can you talk a little bit about pros and cons of getting a mortgage through a bank versus a mortgage company? So in the mortgage lending space, there's kind of 3 different channels you can go through. There's a bank, which would be like your Wells Fargo, Chase, whatever regional bank that you have there. So that's kind of a one size fits all. So it's like, hey, I have my checking account here, so maybe I can get a mortgage through them. So it's a little bit more one size fits all. Most mortgage company or banks do not offer like first-time buyer assistance programs. So that's one of the benefits of mortgage companies. But the bank is one lane. There's also mortgage brokers across the country, which will essentially broker your financials to a lender like us for the financing. So they act as a median, like a middle ground, if you will. And then there's a mortgage company, which we are. So a mortgage company is a direct lender. So we're making our own decisions in the financing. We provide first-time buyer resources. We're a little bit more nimble than a bank because we can make decisions a little bit quicker. We can move a lot faster in the process. But it ultimately depends on what the right fit is for you. We can provide a little bit more customization in the mortgage space. But as I mentioned earlier, we are the number 9 lender in the country as of this year. So really proud of that designation. There's a lot of choices consumers have out in home financing, and we're proud to be one of those top selected across the country. Hopefully I answered that question there for you. I did have another question in the chat that I thought I'd bring to the main audience. So, because it does come up, and which is looking at variable income when it comes to the debt to income ratio calculation, which I didn't get a chance to touch on in the income segment. If you have variable sources like bonus income, commissions, overtime income, even restricted shares that maybe you get through your employer, those are kind of variable sources. In order to count those sources of income, we do have to show that you've been on your job 2 years in order to use those into the qualifying. So let's say I got a bonus of $10,000 in 2024, and I got another bonus this year for $12,000 for Q1 of 2025. We would, as a lender, be able to average that total of $22,000 over 24 months. So that would essentially give us like $1,800 a month that we could use into the qualifying calculation. Okay, so that can definitely be used. So, and Ken, thanks for answering that for our audience member as well too. Any other questions in the audience that we can answer? You guys have been a great class too. So I really appreciate all the questions throughout the class. And hopefully you found this a useful resource for you as you're considering home ownership. Okay. Everybody's sticking around. So I'm just waiting for questions. If you have something, go ahead and drop. There's okay. And thank you for that. Appreciate the feedback. Thank you. All right. Well, I think we did it, and you're very welcome. Thank you so much for attending tonight's class. I hope I get a chance to connect with you and help you build out your own home buying plan on your path towards home ownership. Have a wonderful night. We look forward to seeing you soon. Good night.